Imagine a world where flowers were worth more than houses, where a single bulb could cost 10 times the average annual income. It sounds like a fantastical fairy tale, but it's not. This was the reality during the Tulip Mania of the 1630s. This is the story of the first major financial bubble in recorded history, a tale that reveals as much about human nature as it does about financial markets. Welcome to The Money Trail, where we uncover the hidden stories of financial history. Today, we're delving into the Tulip Mania, a period that saw ordinary people become overnight millionaires, only to lose everything just as quickly. It all began in the early 17th century in the Dutch Republic, then one of the wealthiest nations in the world. The tulip, a flower originally from the Ottoman Empire, had recently been introduced and quickly became a status symbol among the wealthy. But it wasn't just their beauty that captivated the Dutch, it was their rarity and the thrill of speculation. By 1634, tulips had become a tradable commodity. People began buying bulbs with the hope of selling them for a profit. The prices started to skyrocket. By 1636, a single tulip bulb could cost as much as a house in Amsterdam. The most sought-after varieties, like the Semper Augustuses, were worth fortunes. But this bubble was built on sand. In February 1637, the bottom fell out of the market. Panic selling led to a crash, and within weeks, the value of tulips plummeted by 95%. Fortunes were lost overnight, marriages were broken, and lives were ruined. The tulip mania served as a stark reminder of the dangers of speculation and the instability of markets. In the next sections, we'll explore what caused this unprecedented bubble, who was involved, and what lessons we can learn from it. So, buckle up and join us on this journey down the money trail. The Dutch Golden Age of the 17th century was a time of prosperity and innovation, fueled by immense trade wealth. This period also saw the rise of a peculiar form of investment, tulip bulb trading. At its peak, these flowers were worth more than houses, a phenomenon that would become known as the Tulip Mania. Tulips, originally from the Ottoman Empire, were introduced to Holland in the late 16th century. They quickly gained popularity due to their vibrant colors and unique patterns, which resulted from a mosaic virus affecting the flowers. The rarer the pattern, the more valuable the bulb. In 1634, tulip bulbs started being traded on the Amsterdam Stock Exchange. This led to an explosion in prices, with some varieties reaching astronomical values. For instance, the Semper Augustus, a prized red and white tulip, was sold for 5,200 florins, equivalent to the price of a grand canal house or 10 years' worth of unskilled craftsmen's wages. But how did this happen? Several factors contributed to the tulip mania frenzy. Firstly, there was a general atmosphere of speculation and optimism during the Dutch Golden Age. Secondly, tulips were considered luxury items, symbolizing status and wealth. Lastly, the perceived rarity of certain varieties added fuel to the fire. Traders began speculating on future harvests, buying bulbs in advance based on mere sketches or descriptions. A sophisticated system of futures contracts developed, allowing traders to buy and sell tulips without physically possessing them. This increased liquidity and attracted even more investors, creating a self-reinforcing cycle. However, as with all bubbles, there comes a point when reality sets in. By early 1637, the market started showing signs of strain. Prices began falling, and panic selling ensued. Efforts to stabilize the market failed, and within weeks, tulip bulb prices crashed, wiping out fortunes and leaving devastation in their wake. In our next sections, we'll delve deeper into who was involved in this frenzy, what caused the bubble to burst, and how this historic event still resonates today. Stay tuned for more on The Money Trail. The tulip mania of the 1600s was not just a case of misplaced affection for a beautiful flower. A complex set of factors contributed to the unprecedented demand for tulips, sending prices soaring to astronomical levels. At the heart of this phenomenon was the inherent rarity of the tulip. The vivid colors and striking patterns we associate with tulips today were actually the result of a mosaic virus that infected the flowers. This made each tulip bulb unique, adding an element of unpredictability and allure. Furthermore, due to the challenging growing conditions, it could take up to 7 years for a single bulb to reach maturity, significantly limiting supply. But rarity alone cannot account for such frenzied demand. The tulip's exquisite beauty certainly played its part. Europeans had never seen anything like it. These vibrant, elegant blooms symbolized rebirth and renewal, fitting themes in a world emerging from the Dark Ages into the Age of Enlightenment. However, perhaps the most compelling factor driving this market was social status. Owning rare and expensive tulips became a symbol of wealth and sophistication. As the Dutch middle class grew prosperous, they sought ways to display their newfound affluence. What better way than through these coveted bulbs? This desire for social standing fueled competition among buyers, further driving up prices. At the peak of the mania in 1637, a single bulb could fetch the equivalent of several $1,000s today, more than many people earned in a year. So, while we might look back at the tulip mania as an absurd example of speculative excess, remember that at its core, it was about much more than flowers. It was about scarcity, beauty, and most importantly, aspiration. A single bulb represented not just a beautiful flower, but also a ticket to prosperity and respectability. And in that sense, the tulip mania is as relevant today as it was 4 centuries ago. Now, let's delve into the formation of the futures market that fueled this extraordinary speculation. At the heart of the tulip mania was a clever financial instrument, the tulip futures contract. This allowed traders to buy and sell bulbs they hadn't even seen yet, with delivery scheduled for the next growing season. The first such contracts appeared in late 1636 at the height of the craze. A group of Dutch merchants, including Allaire de Long, formed the world's first futures market, the Collegium der Amstel. Here they traded not in grain or livestock as we see today, but in tulip bulbs. A standard contract represented one future bulb, with prices agreed upon months before actual delivery. As word spread about these lucrative deals, more people jumped in, hoping to make a quick profit. And so, the speculative bubble grew, inflated by promises of future blooms that existed only on paper. However, unlike physical commodities, tulip bulbs could easily be multiplied through propagation. This meant that supply could potentially skyrocket, crushing any hope of maintaining high prices. But this fact seemed lost amidst the euphoria of potential gains. As the frenzy reached its peak in early 1637, some bulbs changed hands multiple times a day, each trade pushing up their theoretical value. At the epicenter of this storm was the rare Semper Augustuses, changing hands for astronomical sums. One contract was reportedly sold for 10 times the annual income of a skilled craftsman. Yet, despite these staggering figures, it wasn't just the super-rich driving this market. Ordinary people, enticed by tales of instant wealth, mortgaged their homes, emptied their savings, and plunged headlong into this risky venture. But as with all bubbles, this one burst too. By March 1637, panic selling started, leading to a crash that wiped out fortunes overnight. The government tried to intervene, but it was too late. The dream of prosperity through tulips vanished, leaving behind a trail of bankruptcy and disillusionment. This story serves as a stark reminder of how speculation and easy credit can inflate asset prices beyond rational levels. Fast forward to today, and we see similar patterns playing out in various markets around the world. So, while tulips may no longer be worth more than houses, the lessons from the Tulip Mania continue to resonate, offering cautionary tales for modern investors. 1637. The peak of Tulip Mania. A single bulb could fetch a price that dwarfed the cost of a well-to-do merchant's house. It was an era of frenzied speculation, where fortunes were made and lost on the slender petals of a flower. The Dutch, known for their mercantile acumen, found themselves captivated by the tulip. Originating from the Ottoman Empire, this exotic bloom arrived in the Netherlands via Vienna in 1593. By the early 17th century, it had become a symbol of wealth and status, spawning an insatiable demand that would lead to one of history's most notorious financial bubbles. At the height of Tulip Mania, contracts for future delivery of bulbs were changing hands multiple times before they even bloomed. The most sought-after varieties, like the Semper Augustuses, were traded at astronomical prices. In February 1637, a record was set when one Semper Augustus bulb sold for an astonishing 10,000 florins, equivalent to the cost of a Grand Canal house in Amsterdam. But how did such exuberance take hold? The answer lies in part with the tulip's unique characteristics. Each bulb produced a unique pattern of colors and shapes, making every flower effectively one of a kind. This rarity stoked collectors' appetites, driving up prices. Additionally, the perceived risk of holding tulips was low due to the practice of using virgin soil each year, which limited disease spread and ensured high yields. However, these factors alone cannot explain the scale of the mania. The Dutch economy was booming, fueled by trade with Asia and the Americas. Easy credit facilitated speculation, allowing people to buy tulips on margin, exacerbating price increases. As more investors jumped into the market, hoping to capitalize on rising prices, a feedback loop formed, pushing the market further into irrationality. As we'll explore later, the bursting of the tulip mania would have profound consequences, both immediate and long-term. But first, let's delve deeper into what sparked this unusual craze and why it gripped Dutch society so tightly. Invigorated by relentless escalation, tulip mania reached a boiling point in early 1637. The most sought-after bulbs commanded astronomical prices, with some changing hands for more than a small house in Amsterdam. On February 5th, however, the feverish market suddenly collapsed. The catalyst was an auction organized by the Town Council of Haarlem, which had hoped to capitalize on tulip frenzy and alleviate municipal debt. An anonymous seller offered a dozen Semper Augustus bulbs for an astounding 120,000 guilders, equivalent to about 14 million today. The exorbitant sum shocked potential buyers, who began questioning the underlying value of tulips. As skepticism spread like wildfire, demand plummeted and prices followed suit. The aftermath was catastrophic. Bankruptcy swept through Dutch society, leaving a trail of devastation. Artisans, merchants, even nobles were not spared from financial ruin. Lawsuits clogged courts as desperate individuals sought redress for their losses. Social unrest simmered just below the surface, fueled by anger and resentment towards those who had profited from the bubble. One such individual was Tieleman Coenraadzoon van Bracht, a prosperous Haarlem merchant. His shrewd bulb trading during the height of tulip mania earned him a fortune, only to see it evaporate when the market crashed. Despite his losses, he managed to avoid bankruptcy, thanks in part to his substantial pre-mania wealth. Meanwhile, less fortunate investors turned their wrath toward speculators like Van Bracht. They demanded government intervention, leading to a series of ad hoc measures aimed at mitigating the crisis. In May 1637, the Dutch government effectively declared tulip contracts unenforceable, effectively invalidating millions in paper wealth. Despite these efforts, recovery proved slow and painful. Trust in financial systems eroded, sowing seeds of skepticism that would shape future economic policies. ADS. And while many blamed greed for the debacle, others saw it as a symptom of deeper societal issues, an argument strikingly familiar today. Indeed, Tulip Mania's legacy extends far beyond its dramatic collapse. It serves as a stark reminder of the dangers inherent in unchecked speculation and the fragility of financial systems. More importantly, it underscores the need for prudence and vigilance in navigating the complex world of finance, lessons as relevant now as they were 4 centuries ago. In many ways, Tulip Mania was a precursor to the kind of financial bubbles we see today. One notable example is the dot-com bubble at the turn of the 21st century. Just as tulips once captivated Dutch investors, internet stocks became the new craze in the late 1990s. Fueled by hopes of striking it rich quick, people poured their money into these companies, driving up stock prices to astronomical levels. By the peak of the bubble in 2000, some tech stocks were trading at over 100 times their earnings. But just like tulips, this frenzy couldn't last forever. As investors began to realize that many of these companies lacked solid business models or even profits, panic set in. Prices plummeted, erasing trillions of dollars in wealth and leaving countless investors with heavy losses. The parallels with Tulip Mania are striking. Both episodes were marked by irrational exuberance, speculative fervor, and a sudden, dramatic crash. Another example is the housing bubble that led to the 2008 global financial crisis. In the early 2000s, US real estate prices started climbing at an unsustainable pace. Fueled by risky lending practices and complex financial instruments like mortgage-backed securities, this bubble eventually burst in 2007, triggering a global economic downturn. Again, we see similarities with Tulip Mania, excessive speculation, overvaluation, and a hard landing. So, what lessons can we learn from these episodes? First, always be wary of asset prices that seem to defy gravity. Second, remember that complex financial products often mask significant risks. And third, never lose sight of the fundamental value of an asset, whether it's a tulip bulb or a tech stock. These lessons are particularly pertinent today, as we navigate a world where cryptocurrencies and non-fungible tokens are making headlines. While these innovations offer exciting possibilities, they also carry substantial risks. As history shows, it's all too easy to get caught up in the hype and lose sight of reality. As investigative journalists uncovering financial history, we must remember Tulip Mania and its modern counterparts. They serve as stark reminders of the dangers lurking in unchecked speculation and the fragility of financial systems. Above all, they underscore the need for prudence, vigilance, and a healthy dose of skepticism in our pursuit of the money trail. Reflection. It's clear that Tulip Mania serves as an enduring cautionary tale for investors and financial historians alike. This frenzy, which gripped Holland in the 17th century, provides us with invaluable insights into the fickle nature of speculative markets and the consequences of losing touch with reality. At its peak, single tulip bulbs were changing hands for sums equivalent to the annual wages of skilled craftsmen or even the cost of a beautiful house in Amsterdam. Names like Carolus Clusius, a renowned botanist whose introduction of exotic tulips sparked the craze, and Adrian Pauw, one of the wealthiest merchants who speculated heavily on these flowers, echo through the annals of financial history. Yet, as quickly as it began, the bubble burst, leaving countless investors penniless and disillusioned. Today, we find echoes of Tulip Mania in various forms, from the dot-com crash at the turn of the millennium to the housing market collapse of 2008. These events serve as stark reminders that unchecked speculation can lead to disastrous consequences. They underscore the importance of regulation, transparency, and investor education in maintaining stable financial systems. As investigative journalists uncovering these hidden histories, we have a responsibility to share these stories, not just as fascinating pieces of history, but as lessons that resonate in today's financial landscape. We must remember Tulip Mania and its modern counterparts, for they are more than mere anecdotes. They are warnings etched in the records of time. In conclusion, let us take a moment to absorb the lessons from this extraordinary episode. The tale of Tulip Mania is a testament to human nature's capacity for greed and irrationality when faced with potential windfalls. But it also reveals our resilience and ability to learn from past mistakes. As we continue to follow the money trail, let us carry forward the memory of this floral frenzy, using it as a beacon guiding us towards prudence, vigilance, and skepticism in all our financial endeavors. After all, as history has shown us time and again, what goes up must come down, whether it's the price of tulips or the value of stocks.